Hello, everyone, and welcome to the Marcellus podcast. My name is Anupam Gupta, and I'm in discussion with Arindam Mandal. Marcellus is head of Global Equities. Arindam, welcome to the show.
Thank you, Anupam. Glad to be here.
Good to be here. And let's start with a major milestone that has been recently achieved. 100 crores of assets under management and 2 years stellar record. From there, talk about that.
Yeah, 100 crore. That was quite, I'd say, it's quite comforting, and to some extent, it gives some validation about a product that was actually new in its category, because when we started, there is no actively managed global equity products in India. So we thought about it, and eventually, we built the product, and seemingly, it's getting some pickup, some attention. So yeah, it is quite fulfilling journey in the last 2 years. 100 crore is probably the start, and as you know, the first million is the toughest to get. And hopefully, we have a few more zeros at the end.
There's too many millions.
Yeah.
Why is this milestone important? What's the key message and takeaway? Because here we are in 2024 and everybody's talking about India as a market and 2 billion or 4 billion of SIP money coming in. The buzz is only about India. And here you are with a global fund. What are the takeaways from this?
Right. So, look, there is no question that where India stands now, the next 5-10 years, it's really bright in terms of economic growth. There's no doubt about it. The point that we're trying to make here is that there are opportunities that exist outside of India. And as an investor, you should not keep all the eggs in one basket. Even though, the economy that we can see for the next 5-10 years, that looks great for India. But that not necessarily means that, there is no risk to it. And when you're diversifying, you are basically mitigating or kind of reducing some part of the risk. And that is exactly what we're seeing. In fact, one data point even I found fascinating was that sometimes we just correlate economic growth of a country to the equity market return. That is typically not the case. In fact, if you just do a simple statistical regression, take the highest growing countries and how the equity markets of those countries have returned, there is not much of correlation. Definitely India has been one of the best markets in last 10, 20, 30 years, any time frame that you look at. Just look back, 30 years. If you think about 1993, $300 billion GDP, India, now 4 trillion, 13x in 30 years. Compare that to US. US was a $7-8 trillion economy back in 1993. Now it is around 32, 3 or 4x. Had you invested 100 rupees back there in Nifty 50 in 1993, would have become around close to 4,000 or something like that. Had you invested in S&P, it would have become like 6,000. The point is that, and that too at much lower volatility, right? So that's the point that, equity market returns and economic growth, they are not closely correlated to some extent. Of course, I expect the Indian market to do really good in the next 10 years, but at the same time, just hedge with appropriate assets, which are not that correlated, but at the same time, you're not losing out on the returns in longer term. So your wealth creation journey becomes much more smoother. So that's what as an investor you want.
So talking about journey, talking about diversification, talking about cutting risks, here you are. You left the US and you came back to India. Right?
Yeah.
So it's an example of reverse brain drain, because here in India, everybody wants to send their kids abroad. And you spend time out there, you've come back here. What's your journey been like?
Look, I moved to US in 2011, 2012 for my MBA. Again, just before that, I was a software engineer. I was working with Oracle in Hyderabad. And then just got some interest in finance. India is having a kind of bull market, if you can recall that time from 2007, 8, 9, 10, right? We had a GFC, but that didn't really impact India that much. Just wanted to get a little better hold of, about the financial markets, to be very honest. And when I went to Duke University, and it gave me that platform. So, but some fascinating professors. I had a chance to study under, Professor Campbell Harvey, who is the kind of, the guy who actually talked about yield curve, right? That we hear every day actually now. So things like that, so that kind of brought my attention to asset management, thought about taking it as a profession, then joined Principal Global Investors, started as an analyst towards 2018-19, started looking into different regions, multiple sectors. Yeah, so towards end of 2020, 21, I was thinking, exploring about uh, building an asset management business on my own, like raising capital, etc. And at that point of time, actually, I knew Saurabh from his previous Avada. I used to work with Ambit, and Ambit was one of the brokers that he used to use in principle. So, when he talked about, like, what about running a global fund from India, because there is a need for the reason that I just told you. So that's how it was organic development. And towards 2021, end of 2021, early 2022, I decided to give it a fair shot. You can actually raise assets. So I think that we had the capability to, with the skill set to actually run a portfolio. Now, how you do it, that is a separate challenge altogether, but we took the plunge of doing it. So I would say that, the opportunity set in India in terms of building asset management businesses, like the amount of money that is coming out. And if you think about the wealth being created, right? If you look at the own rich list or anyone, actually, the phenomenal wealth has been created. Right? Yeah. So if that is the case, as you are going up in your wealth creation journey, the need to have more sophisticated products rather than vanilla products become more and more. And that is where we feel that there's a need and we can make a good product. So that's how I'll not say it's reverse brain drain or whatever you can call it, but we wanted to make a good product. We wanted to make it out of India. So you can call it Make It India kind of global equities product that way. But that's what we wanted.
And what is the concept of global equities? In the markets now, there is all kinds of fads and things happening. And so is global equities a part of that, or is there something new to it?
The global equities, you're basically trying to invest in stocks that are not in a domestic country. So if you're an Indian investor, you're basically talking about investing outside of India. If you're an US investor, you're actually talking about fully investing in emerging markets, etc. So what we are saying here, primarily for our resident Indian clients, that for diversification, both conceptually as well as if you think about the thematic diversification, you should think beyond just investing in your domestic equities. Now, why we are saying that? Because many of the things that we're using on a daily basis, like you think about Amazon or the phones that we're holding, those are actually not, most of the things are not made in India. Even if you think about Apple iPhones are made in India, but the IP and most of it actually have been captured somewhere outside of India. The point is that if you are so globally connected, as you're getting more and more wealthy as a country, it will be more connected to the global kind of the trading forces, etc. So in that case, how do you benefit from what you're consuming? So to that point, of course, your returns might get boosted on the diversification, the mathematical part of it. Yeah. Similarly, qualitatively, thematically, you're also getting exposed to certain themes that is very hard to get in India. So that's our pitch about global equities.
I want to understand the numbers behind this. Okay, because I remember reading some of the material that the S&P 500, pretty much the most widely followed equity index in the world, right, versus either the Sensex or the Nifty, the past return performance actually makes a very strong case for diversification. Can you just recap that for our viewers?
It does. In fact, so if you look at 10, 20, 30 year data, the overall returns are not that different. S&P has done slightly better in 10 and 30 years. The Indian market has done slightly better in 20 years, but very comparable. What really separates them is the volatility. It is a more developed market, more liquid market per se, the US market. So as a result, what happens is that, if you combine both of them, the overall volatility comes down. In fact, what was striking to us was that if you take any major equity markets in the world, like say MSCI Europe, MSCI Japan, MSCI EM, emerging markets, and look at the correlation between the 3-year or 5-year rolling correlation between India or S&P against any of these countries or any of these regions, India and US, they have the lowest correlation, which is actually fascinating because you have these two best performing equity markets. You combine them, they are not that correlated. And if you think through it, we actually looked at different time periods. For example, the trade war that happened in 2018, right? it was in the same year as, the ILFS crisis, but not at the same time, right? So again, if you're balanced in both these markets, both the market will give you opportunity when you can top up. Similarly, if you take up any global crisis for that matter, the Indian market tends to fall more compared to the US market. The reason being, dollar is kind of the de facto currency of the world, so it's a safe haven. So that's natural hedge for any investor, and that gives you, you're getting protected from the black swan kind of events, right? Similarly, on the flip side, if you think about the 2022 downturn that US saw, India didn't see anything then. So both the investor can get benefited because, as I said, two best performing country, but not working at the same point of time. That's the best of both, actually. That's what you want.
So I want to understand this because global equities is a vast concept, right? Now, how did you and the team at Marcellus ensure that you have a sustainable construct? Because tracking global equities requires a certain amount of deep research capabilities, process, access to information. How did that come about?
Yeah, so Anupam, I mean, the access to information is probably the relatively easier part these days because there's too much of information actually. The challenge is how do you cut down the noise from signal actually. The bigger challenge when we started, I mean, the initial 3 to 6 months was like, how do you actually build a team? How do you build the process? How do you get the right set of people? So we spent quite a bit of time and we kind of, looked through these challenges separately. The first thing was to build a team, please. Now, what we noticed over the last 10 years is that many of these buy-side or sell-side firms, post-GFC, they built their back office or middle office in India. I'm not talking about the IT back office. Even the analysts, actually, you'll find Goldman Sachs have their asset management firm, their wing, and there's some analysts sitting in Bangalore or Bombay. Similarly, JP Morgan has similar kind of setup. Similarly, on the buy-side, Fidelity, Allianz, Boston, they have their kind of back office tight integrated towards many others. Now, based on our understanding, we figured out that, that is actually a good talent pool that we can scout. So if you look at the team that we have now, you'll find that most of them have actually kind of reasonable experience in covering international equity. So that is challenge number one. And then, of course, we wanted a really, really good, head of research who has has looked into different set of equities, like a different set of equities after different countries, different sectors. And luckily, we found Jaiveer, who runs the fund with me. So he used to work with Premji. Premji Invest, the largest family office, was the head of research there. We pitched the idea of running global equities from here, and he kind of, accepted the challenge. So he heads the research division, and having, he has been in the industry for more than probably 20 years now. So both in sell side and buy side. So he kind of designed the process that how we can do the research, etc. So again, finding key people are the first step. Now, designing the process was the second thing. That one thing about Marcellus is that there is no compromise in terms of the quality of research that we're doing. The challenge was that how to do the primary research around any company. And as a primary research, you need to really talk to the ex-employees of the company that you're working on. Suppose I'm working with Apple, I'm working on Apple. I need to really understand, the different part of the value chain. You are making some things in China, you're procuring some things from TSMC, right? So you need to understand, having an understanding of all these moving pieces and make a thesis on your head, right? So we try to build a system which gives us access to people, who we can reach out. You can talk through these things to really deep dive primary research. For every company that you're looking at, we're probably looking at 25 to 30 interactions at least for every company that you're doing work on. And then of course there is travel. If you're covering consumer company, you cannot really buy that company unless you have the touch and feel of any consumer company, right? So that travel part is more mechanical, I would say. It was mandatory, but the to get the finer nuances of understanding a culture of a company, that is where you need to talk to various people. How we sorted that out, with different ways. Actually, we tied up with different sort of export network services, which actually pay them for every interaction, stuff like that. But what I can say is that, it is foolproof. I shouldn't say foolproof because nothing is foolproof, but it's a very well built structure in terms of quality of research. I mean, we're as convinced on any of our thesis that I have in our portfolio companies today. We say a company of an Indian company, like if you're covering Asian Paints, the kind of conviction you have in Asian Paints, have similar kind of conviction in Arby's. I do have in Chogi Pair.
So you spoke about Arby's right now. What sort of a diversification does a client investing only in India get from global equities? I mean, I think what I'm trying to figure is, now that I'm investing in global equities, what's the exposure and getting to something that's not available in India? What caliber of companies?
I mean, Arby's is a classic example, right? So we talk about the whole rich list, a lot of billionaires, and we always talk about, this K-shaped recovery, and that is not just India, it is globally. Now, Arby's is a kind of a monopoly in the leather goods, that leather bags, that highest, the most premium end of the most like super luxury end of the handbags. Now, can you get something like that in India? Probably not, because building an Arby's is not a 5 or 10-year-old job, right? When Arby's is a 180-year-old company, it's built on the heritage, right? They have maintained kind of scarcity, etc. So when you're trying to play the big theme, the wealth disparity or K-shaped recovery or polarized world, whatever it is, there is no better play in my view than an Arby's or a Ferrari of the world. Similarly, if you think about in every day we're using these phones, right? Now, who makes the chips for those phones, right? We can say that we're building a factory or we're supplying certain parts, etc. Just think about it. Foxconn makes most of the iPhones and assemble most of them. Foxconn's market cap is around $50 billion. Apple's market cap is $3.5 trillion. Right? So when you are manufacturing the final product, it doesn't really add that much of that. But we are trying to identify companies like TSMC, right? Who are actually helping Apple to stay cutting edge, right? So those kind of opportunities you never get being in India, even though you are actually adding to their revenue growth.
Arindam, why developed markets? Global equities is this massive, it's globe, and you've got a lot of countries, a lot of regions where you could invest, but he's chosen a different approach. Tell us about that.
Yeah, so I had the opportunity to cover emerging markets. Different sectors in emerging markets, briefly China and briefly Japan also. Japan is developed market, by the way. So my understanding was that there are two ways you can make money. One is trading, another is investing. And what we're trying to do here is that long-term investing. That's what we're trying to do. When you're thinking about investing, there is certain level of institutionalization of the countries that we're investing in. That should be there. And that is the challenge that I find with many of the emerging markets. The governance, the way actually can make your shareholders wealthy, how supportive the government about doing that, etc. You don't find it in too many countries. That took me by surprise, actually. In fact, China is a classic example. Forget about what happened after COVID, etc. Even if you look at from 1994 to 2019, the glorious period of China, the market cap of the market went manifold, no doubt about it. But if you look at the per share returns, that was actually minuscule. So one thing that we need to understand, even in India's case, that we need to understand is that, being big doesn't mean that you're actually making your minority shareholders rich, right? So you're diluting them maybe if you're trying to be big, too quickly. And the second thing I would say, why do you have the competence when you're building a product? So again, briefly covering China and Japan, what I understood is that you need to actually know or understand the local language. Today, you find the gems out of those countries. There are really very, very good companies there. Otherwise, what happens is that you are basically stuck with the large names that you hear about. It be Tencent, Alibaba, Meituan. I mean, there are a few flagship names. That's what most of the people actually keep investing, which is fine. I'm not saying that it's right or wrong. But if you really find out the gems, then you actually need to be a local, given that disclosures, etc. they are not engaged. So that is a hard task. We don't want to do anything, very shallow when you're doing research. So we wanted to make sure that, the find the regions which can make your shareholders richer. And I'm very particular about it. I mean, one of the regions that might surprise you is Nordics. Yeah, so we found actually that's a great country to invest. I mean, if you think about a small country like Sweden, and if you think about the kind of companies that they have produced over the years, Electrolux, Volvo, Spotify, there are Atlas Copco. You can just name a lot of them in a country which is less than 1 crore population probably, right? So yeah, so we have been very particular about what the countries that we're choosing, which can be source of good vegetation, and that's how we. And secondly, as I said, where we can actually build our competency. Those are two reasons that we went for this.
Sure. Let's wrap up this episode by talking about the most important question for anybody who's watching this. कितना और कैसे and कितना invest करने का और कैसे invest करने का. So first, let's go कितना. How much can I, or what's the ticket size out there that we're talking about?
All right. So look, I mean, it's a PMS structure out of GIFT City. So the GIFT City mandate is that the minimum ticket size is $150,000, and it is all dollars. It is not talking about rupees or anything like that. So that's the GIFT City rule, that 150,000. But there is a caveat there. If you are an accredited investor, then you can actually start with 25,000. Not that 25,000 is not GIFT rule. There is a rule that we have imposed. So 25,000 is technically the minimum that you will start with. And then secondly, for resident individuals, these are ARS money.
Okay.
So for every PAN card, you can send actually $20,000 every year. So this money will go from that pot actually, whatever you want to say. So you have to go to your bank and say that, so that I want to transfer this much in this bank account. And then that gets converted dollar, and that amount will get invested in the PMS fund. So what I've done is that we have tied up with Interactive Broker. So they are basically broker dealer and who have like account which you can monitor on a daily basis. You can see the holdings, the amount of shareholding that we have, etc. Very transparent, very easy process to set up. So so that is what it is. Interactive Broker, minimum amount $50,000 by rule, accredited $25,000.
And kaise? I'm just visualizing this like I'm buying dollars. Is that dollars flying away somewhere and landing in the US, or how does that work?
No, so GIFT City is kind of this concept, like that government of it created to replicate some of the success that DIFC had in Dubai. So you are physically in India, but technically you are not in India, right? So when you're sending the money in a GIFT City pooled account like that you have, Kotak or ICICI, so technically your money is actually outside of India. Now it is up to you how do you want to use it. So you can give it to us. Basically, that's what we're saying, that if you really want to invest with us, transfer it to our account, then it gets deployed to the stocks that you're buying in.
Very interesting. I know what are the free benefits I have for owning a foreign portfolio. Like, for example, now that I have always shared in my DMAT, we've got entitling you to some free bags. I just saw Zindagi Na Milegi Dobara, and there's a Hermes pack in that. They call it Bagwati. So do I get that also?
So I mean, you can go to Paris, and at least you might not get a bag, but I'm sure you can get an entry to the analyst day.
Okay.
And maybe kind of back interest of written armies. I don't know.
I read this post at Marcellus about Rolex.
Yeah.
They've got some very complicated procedure of, will I get a Rolex, for example? Can you help me get one? It's something that's very easy, but that's very tough to get these days.
Yeah, so I don't think we can help you on that. So the biggest, the biggest benefit I ever had being a shareholder of any company so far is being able to attend the Berkshire Hathaway meetings.
Oh, you've actually got the Oman?
Yeah, so I was in Des Moines for a long time. So it's a 2-hour drive from Des Moines. So we used to go every year actually. So you get a ticket for having.
And you make buffet and bunker, or you've seen them at least?
Yeah, I've seen them, and we used to run a large portfolio. So we had the privilege of sitting in the front rows and all that stuff.
What was that like?
It was great. I mean, actually, so Bill Gates used to sit in the board at that point of time, just sitting behind them. In fact, I went with my wife. She's like, who's fan of Bill Gates? So I just kind of is good. I mean, you're kind of watching them and taking a picture if you can, things like that. It's good.
Awesome.
Yeah.
Any lessons from there for the Indian markets?
So I don't know why he hasn't put his money in India. I mean, there's a question I think he get asked often. But probably I'll not say, the biggest lesson that I have understood from what he said is that there are very few markets where you can find long-term compounders in the institute, that setup that I was talking about, policy, etc. And one thing I understood that India has that kind of setup that you can actually find long-term compounders. You can actually find a Berkshire equivalent, at some point of time. Not many market can give you that. If you just think about any other country, very few. There's no company in China that can give you a Berkshire which has a kind of long-term 70, 80 years or 60 years of compounding. So, so attending those things, the nuances, like how one country can be successful in generating long-term equity returns. When I used to go there, never bet against America. All right, that's what I used to always say. Then I asked him, like, why not? I mean, the typical thing, 4-5% growth, and what do you do with that? They don't really understand, it is not about that. It is about, how the country operates, what makes the country great. So those are the answers that I had.
Fantastic.
And that is a wrap on this episode of the Marcellus podcast. I'm your host, Anupam Gupta, and our guest, Arindam Mandal. Marcellus is head of Global Equities. Arindam, thank you so much for doing this for our listeners.